How to protect your wealth in a changing world order. The map is changing beneath your feet. Look around you. Right now as you're watching this, the world is running multiple crises simultaneously, and most people are treating each one as isolated news. Russia's war in Ukraine has permanently reconfigured European energy supply chains. The US-China trade war has fractured the global semiconductor industry. Inflation has eroded purchasing power across the entire Western world at a pace not seen since the 1970s. And a direct military confrontation between the United States and Iran, something that was theoretical a few years ago, has moved to the front page. For most people, this is background noise. It's tragedy or politics or someone else's problem. But I want to offer you a different lens today, because history is unambiguous about one thing. Geopolitics does not stay in the headlines. It migrates quietly, inevitably, into your bank account, your retirement fund, and the purchasing power of everything you've worked to save. Today, we're going to do something most financial content refuses to do. We're going to connect those headlines to your personal financial reality, and then build, step by step, what I call the Wealth Fortress. A concrete, tiered strategy that any ordinary American investor can actually implement. But before we get there, I want to make you a specific promise. By the end of this video, I will show you the single most dangerous mistake American investors make regarding bank bail-ins, a mechanism that is already embedded in US law that almost nobody talks about. And that could affect deposits well below the level you're probably imagining. That's coming in part 1. Don't skip ahead. One more thing. This is not a video about the end of the world. It's a video about the end of the illusion that your wealth is protected simply because you live in America. Those are very different things. The pattern that repeats. 500 years in 5 minutes. Let's start with a question that seems historical, but is in fact urgently practical. Why do powerful financial systems collapse? Ray Dalio, the founder of Bridgewater Associates, the world's largest hedge fund, spent decades studying every major empire and financial system over the past 500 years. His conclusion is deceptively simple. Every great power follows the same arc. It rises on real productivity, manufacturing, trade, innovation. It then expands its power through debt, and eventually it reaches the point where it can no longer service that debt without doing one thing: printing money. Printing money to stay debts is called currency debasement. It's not theoretical, it's a mechanism, and it always ends the same way. The purchasing power of the currency erodes, the middle class is hollowed out, and the people who held their wealth in that currency alone lose a significant portion of it. Not suddenly, but slowly, and then all at once. The United States is not immune to this pattern. The US national debt has surpassed $36 trillion and is growing by roughly $1 trillion every 100 days. The annual interest payment on that debt now exceeds $1 trillion, more than the entire defense budget. To put that in personal terms, imagine your minimum credit card payment was larger than your rent. You can keep paying for a while, but not forever. In 1971, President Nixon made a decision that fundamentally changed the rules. He severed the link between the US dollar and gold, ending the Bretton Woods system under which foreign governments could exchange dollars for gold at a fixed rate. After that, the dollar became what economists call a fiat currency, backed not by anything physical, but by trust in the US government. Since 1971, the Federal Reserve Bank of St. Louis data shows the US dollar has lost over 85% of its purchasing power. Put simply, what cost $1 in 1971 costs more than $7 today. That is not a prediction about the future. It is a documented fact about the past. The real risk today is not volatility. It is the illusion of normality. That line is worth sitting with. Volatility is visible. You see it in red charts and alarming headlines. The illusion of normality is invisible. It's the feeling that because your 401k went up last year, everything is fine. It's the assumption that because a crisis hasn't happened to you personally, the structural risks don't apply to you. That illusion is historically the most expensive thing an investor can own. 3 crises that already changed the rules, and most people missed it. Let me give you 3 concrete recent examples of the system changing in ways that should alter how you think about your money. Example 1. Russia-Ukraine. The weaponization of finance, 2022. When Russia invaded Ukraine in February 2022, the Western response was far beyond military aid and diplomatic pressure. Within days, the US and its allies froze approximately $300 billion in Russian central bank reserves, held in Western institutions. They cut Russia off from SWIFT, the global interbank messaging network that underpins virtually every international financial transaction. Russian oligarchs saw yachts, properties, and accounts seized across multiple jurisdictions simultaneously. The message to the rest of the world was unmistakable. The Western financial system can be turned into a weapon, instantly, by political decision without a court order. Each government and central bank on Earth took note. The BRICS nations accelerated their work on alternative payment systems. Saudi Arabia began settling some oil trades in yuan. The infrastructure for a post-dollar world starting being built in earnest, not as a theoretical project, but as a geopolitical necessity. Example 2. The 2008 financial crisis, when SAFE became catastrophic. In 2006 and 2007, Bear Stearns was selling investment products called high-grade structured credit-enhanced leverage funds. The name sounds impenetrable by design. What they actually contained was a massive exposure to subprime mortgages, loans made to people who could not afford them, packaged and repackaged until the original risk was completely obscured. In June 2007, those funds collapsed. Bear Stearns was acquired by JP Morgan in a distressed sale within a year. Lehman Brothers followed in September 2008. The entire global financial system came within days of a complete freeze. The lesson is not that Wall Street is corrupt, though it sometimes is. The lesson is that SAFE is a label, not a guarantee. And right now, we are seeing strikingly similar patterns in the institutional market. Funds marketed as high grade or low risk that are quietly shutting down, one by one. Example 3. The 2022 European energy crisis. Supply chains don't rebuild overnight. When Russia invaded Ukraine, Europe discovered something painful. Decades of dependence on Russian natural gas had created a structural vulnerability that could not be fixed quickly. European energy prices surged to levels that threatened industrial viability. Germany, the manufacturing engine of Europe, saw energy costs that made certain industries economically unviable. European inflation spiked sharply. Germany's economy ultimately contracted. Supply chains were permanently reconfigured, with reshoring and friendshoring becoming strategic priorities. The point is not that energy crises are new. The point is that modern interconnected economies can be destabilized with surprising speed by geopolitical events. And the effects ripple far beyond the immediate crisis zone. These 3 events share a common lesson. The rules of the financial system can change faster than your portfolio can adapt, unless you've prepared in advance. The bail-in, the number 1 mistake American investors make. I promised you this at the start, and here it is. The single most dangerous and underappreciated risk in American personal finance right now. Most Americans have heard of a bank bailout. That's when the government rescues a failing bank with taxpayer money, which is what happened in 2008 with AIG, Citigroup, and Bank of America through the TARP program. The government steps in, the bank survives, depositors are protected. But after 2008, regulators around the world decided that using taxpayer money to rescue reckless banks was politically and economically untenable. So they created a different mechanism. They call it a bail-in. In a bail-in, instead of the government rescuing the bank rescues itself using your money. Your deposits are converted into equity shares of the failing institution. You didn't agree to this. You didn't vote on it. It simply happens by a regulatory mechanism when a bank is deemed systematically important and in danger of failure. This is not a conspiracy theory. It has already happened. In March 2013, Cyprus experienced a severe banking crisis. Working with the EU and the IMF, the Cypriot government implemented a bail-in on all deposits above €100,000. Overnight, large depositors saw approximately 47.5% of their savings above that threshold converted into shares of a bank that was functionally insolvent. That money was effectively gone. Here is the mistake most Americans make. They believe the FDIC's $250,000 insurance limit protects them. It does, for bank failures in normal conditions. But bail-in mechanisms apply to deposits that are converted to equity before the FDIC insurance mechanism is triggered. In a systemic crisis involving multiple institutions simultaneously, the sequence matters enormously. The bail-in framework is embedded in the legal structures of the US, EU, UK, Canada, and Australia. It was designed for exactly the kind of multi-institutional systemic stress that we may be approaching. Business owners with large operational cash balances, real estate investors with significant liquid reserves, and anyone with deposits meaningfully above $250,000 at a single institution should understand this risk and structure their holdings accordingly. The practical implication is straightforward. Spread deposits across multiple institutions. Keep excess cash in treasury-backed money market funds, which are not subject to bank bail-in mechanisms. And don't treat "it's in the bank" as synonymous with "it's safe." Now, if what we've just covered feels overwhelming, don't worry. I've summarized the entire technical structure we're about to discuss into a free PDF guide. The Architect's Guide to Sovereignty. It's a step-by-step blueprint of this entire strategy. You can find the link in the description below, but stay with me for now, because you need to understand the why before you can execute the how. 2 economies, 1 country. Here's a question I want you to sit with. Can an economy be both booming and broken at the same time? The answer is yes. And understanding why requires you to look at 2 completely different datasets. The first dataset is the S&P 500. By that measure, the US economy has had remarkable years. But the S&P 500 is, at this moment, largely a story about a handful of mega-cap technology companies, the so-called Magnificent Seven, all of them riding an AI investment wave that has inflated their valuations to extraordinary levels. Strip out those 7 companies, and the remaining 493 stocks in the index tell a considerably more cautious story. The second dataset is what I call the real economy, the world of consumer spending, small business hiring, credit card debt, and car payments. And that economy is right now waving a white flag. The velocity of money. Why Amazon and Wendy's are your leading indicators. There's a concept in economics called the velocity of money. It measures how quickly a dollar circulates through the economy, how many times it changes hands in a given period. When the velocity of money is high, economic activity is strong. When it slows, the economy stagnates. And when it collapses, recession follows. The most reliable indicators of declining money velocity are not found in Wall Street data. They're found in the behavior of consumer-facing businesses that serve ordinary Americans. Consider what's been happening. Amazon, which alongside Walmart has become the backbone of American retail, announced significant layoffs across multiple divisions. When Amazon stops hiring aggressively and starts cutting, it's telling you something about consumer demand. Amazon's revenues are a direct function of what American households are spending. When that spending slows, Amazon reacts. Wendy's and other fast food chains have been closing locations and struggling with same-store sales. Fast food is not a luxury. For tens of millions of American families, it's a budget meal. When people start skipping the drive-thru, it means their discretionary budget has been compromised to nearly zero. These aren't corporate restructurings. They are data points. Each one represents a reduction in the circulation of money, a slowing of economic velocity. And historically, when you see this pattern across multiple consumer-facing sectors simultaneously, a broader market correction has followed within 12 to 18 months, in every instance since World War II. Don't watch Wall Street to understand the American economy. Watch CarMax. Watch Dollar General. Watch fast food same-store sales. Those are the vital signs of the real patient. CarMax is the largest used car retailer in the United States. Used cars, not new cars, not luxury vehicles, are what ordinary Americans need to get to work. They're not discretionary. So when CarMax struggles, it's a direct signal about the financial health of the American middle class. The stock dropped sharply in a single trading session when earnings reflected a consumer base that had simply run out of capacity to borrow. The average monthly payment on a new car loan in the US now exceeds $700. For a household earning the US median income of approximately $60,000 per year, after taxes, roughly $48,000 per year. That's over 17% of take-home income going to a single car payment. That threshold is not sustainable for most families, and the data is showing us it isn't being sustained. Credit card delinquency rates are at their highest levels since 2011. The personal savings rate has fallen from a pandemic peak of over 30% to below 4%. The consumer stimulus that powered the economy from 2020 through 2023 has been fully spent. And the Americans who stretched their budgets to buy homes at 3% mortgage rates, unable to move, unwilling to sell, while everything around them gets more expensive. The 2008 Echo, pattern recognition for the prepared investor. In October 2007, the U.S. stock market hit an all-time high. In December 2007, 2 months later, a recession had already technically begun, as the National Bureau of Economic Research would later confirm. The market didn't reflect this reality for another year, when Lehman Brothers collapsed and the full severity of the crisis became undeniable. Today's pattern carries the same fingerprints. Major financial institutions are quietly shutting down funds marketed as high-grade or low-risk. Precisely the language Bear Stearns used in 2007 for products that were, in reality, stuffed with subprime exposure. Jamie Dimon has warned publicly about cockroaches in the financial kitchen. His way of saying that visible problems are rarely the only problems. History does not repeat precisely, but a prepared investor recognizes the rhyme before it resolves into a crisis. The global synchronization problem. Here's what makes the current environment particularly difficult to navigate. The stress is not isolated. It's synchronized. Europe is still absorbing the inflationary aftermath of the 2022 energy crisis. Germany's industrial base, the manufacturing engine of the continent, contracted in both 2023 and 2024. Japan, which has maintained the world's largest debt-to-GDP ratio, is showing bond market stress that has its own central bank in a near impossible position. China is working through a property crisis that some analysts compare to the US housing collapse of 2008, but potentially larger in absolute terms. When major economies face simultaneous stress, the usual buffers disappear. In normal conditions, when the US slows, capital flows toward Europe or Asia, creating economic activity there. But when everyone is slowing together, there's nowhere for that capital to go, unless it moves into hard assets, into gold, into currencies, and jurisdictions that are not all falling simultaneously. This synchronized global fragility follows a recurring historical pattern. Interconnected financial systems tend to fall in sequence once the first domino goes. The 2008 crisis didn't stay in US subprime mortgages. It swept through European banks, emerging markets, and commodity economies within months. Modern finance has no firewalls. When everything is correlated, the usual escape valves simply don't open. Traditional diversification, owning different types of US assets, does not protect against global fragmentation. When everything in one system is correlated, spreading across that system is not diversification. It's rearranging deck chairs. The housing mirage. Let's address the asset that most Americans treat as their primary store of wealth, their home. US homes have remained remarkably elevated, even as mortgage rates rose from 3% to above 7% in the fastest rate increase cycle in modern US history. At 7%, a $400,000 home costs significantly more than a $650,000 home did at 3% rates. This should have crushed prices. In terms of transaction volume, it has. Home sales are near historic lows, but prices have held. Why? Part of the answer is a frozen market. Millions of homeowners locked in at 3% are rationally unwilling to sell and take on a 7% loan for the next home. But another part of the explanation is more troubling. Large home builders are engaged in sophisticated financial engineering to maintain price appearances. Rather than officially cutting prices, which would lower comparable sales data and trigger neighborhood-wide reevaluations, they offer massive buyer incentives. $50,000 in closing cost credits, free upgrades, rate buydowns to 5% or 5.5%. The official price remains high. The real economic value of the transaction is materially lower. If you own a home, your estimate reflects this distorted market. It's a theoretical price in a market where almost nobody is actually transacting. When forced sellers enter the market in numbers, through job loss, divorce, estate sales, or investor distress, the reset could be substantial. This is not a prediction. It's an invitation to intellectual honesty about what your net worth actually is, versus what it appears to be on paper. We're about to look at the assumptions that put your wealth at risk. If you're finding value in this analysis, make sure to subscribe and hit the notification bell. Also, the Architect's Guide is available right now in the description to help you secure your assets against current tensions, like the US-Iran situation. But I have a challenge. If this video helps us reach 10,000 subscribers, I will release an exclusive deep dive featuring the specific list of international banks that have historically survived global asset freezes. Let's build this community together. The 3 assumptions. Before we get to the solutions, I need to address the room directly. Because if you're like many Americans watching this, you may feel a specific kind of resistance. It sounds like this. Most Americans carry 3 assumptions about their money that feel like common sense. The first, that diversifying internationally is somehow un-American, even suspicious. The second, that this kind of strategy requires millions. The third, that the dollar's dominance is permanent and guaranteed. All 3 are wrong, and each one costs real money. On the first assumption, every Fortune 500 company headquartered in the United States holds assets in multiple currencies and maintains subsidiaries across dozens of countries. Apple holds hundreds of billions in overseas cash, not because Apple is unpatriotic, but because Apple doesn't bet its entire future on one country's fate. The Wall Street Journal has documented how family offices, the private wealth managers of America's ultra-wealthy, are doing exactly this right now, rotating toward defensive assets, increasing gold, reducing cyclical exposure. That is not a fringe strategy. It is a standard institutional practice, finally made accessible to everyone. On the second assumption, an international ETF costs $10 to buy. A gold position can be started with a few hundred. The tiered framework in Part 5 has a starting point for the investor with $25,000 and a different one for the investor with $500,000. The principles are identical. The tools are the same, only the scale changes. On the third assumption, the permanent dollar, the British pound was the world's dominant reserve for 100 years before it wasn't. The dollar share of global central bank reserves has fallen from 73% in 2000 to roughly 58% today. Not a collapse, a direction. And a direction held over 25 years, combined with active efforts by major economies to build alternatives, is not noise. It is a signal. The prudent investor doesn't put their entire 30-year financial future on that direction reversing. None of this requires abandoning your country, hiding money offshore, or doing anything remotely suspicious. It requires the same clear-eyed risk management that every major institution in the world applies as a matter of routine. Now, let's build it. The architecture. Why a fortress, not a portfolio? I've been using the term wealth fortress deliberately, not portfolio diversification, not asset allocation. A fortress. The difference matters. A portfolio is optimized for returns under normal conditions. A fortress is designed to survive abnormal conditions and then allow you to profit from the recovery. The goal of the wealth fortress is not to make you the richest person in a bull market. It's to make you the most resilient person in a crisis. A fortress has 4 walls. Each wall performs a distinct protective function. Together, they create a structure that no single geopolitical event, no single currency crisis, no single market collapse can bring down entirely. Wall 1. Liquidity. The most crucial defense in any crisis. In a financial crisis, liquidity is the only currency that matters. Not the value of your assets, but your ability to access that value when you need it. The person with 3 investment properties and no liquid assets will make terrible decisions under pressure because they have no options. The person with a liquid, diversified portfolio has time, flexibility, and choice. Wall 1 is built from assets you can convert to cash within 24 to 48 hours without a significant penalty. ETFs qualify. Liquid REITs qualify. High-yield money market funds qualify. Physical real estate does not. Your 401k with early withdrawal penalties does not. Not in its inaccessible form. Target. Ensure at least 30 to 40% of your investable assets are in genuinely liquid form at all times. Wall 2. Geopolitical diversification. Assets that survive political risk. Wall 2 is built by spreading your financial exposure across multiple jurisdictions, currencies, and legal systems. The goal is to ensure that no single government's decisions, whether about taxes, capital control, bail-ins, or currency policy, can affect your entire financial life. This wall includes international diversified equity ETFs, physical gold held in neutral jurisdictions, and for larger portfolios, accounts in Swiss or Singapore financial institutions. Target. At minimum, 20 to 30% of your investable assets should be outside the US dollar and the US legal system. Wall 3. Sectoral resilience. Exposure to sectors that survive and thrive in stress. Wall 3 is built by ensuring your equity exposure is not concentrated in sectors that are most vulnerable to the specific risks we've discussed. Tech valuations that depend on AI promises being fulfilled. consumer discretionary companies exposed to the tapped-out middle class, and financial institutions that carry hidden systemic risk. This wall is built with quality-screened equity exposure, real assets like REITs and commodities, and positions in sectors that tend to be resilient or counter-cyclical: healthcare, utilities, and global infrastructure. Target: at least 30% of equity exposure in quality-filtered or defensive sectors. Wall 4. Long-term vision: the discipline to hold through false dawns. Wall 4 is not a product, it's a mindset. It's the ability to maintain your strategy through market volatility, through alarming headlines, and through the false recoveries that will inevitably occur before the structural adjustment completes. This wall is built through preparation. Having a written investment policy statement, understanding why you own what you own, and committing to your allocation before a crisis tests it. An unprepared investor makes decisions based on fear. A prepared investor has already made the decisions. The crisis becomes noise, rather than a call to action. The Flag Theory Framework: planting sovereignty across jurisdictions. Within the four walls, I use a specific implementation framework called Flag Theory 2.0. The concept is simple. Just as a fortress has multiple walls, your financial life should have multiple flags. Positions in different areas, currencies, and legal systems that ensure no single authority controls your entire financial existence. Let's go through each flag in concrete detail. Flag 1. The currency flag. VXUS and international equity. The most accessible and powerful first step in currency diversification is the International Equity ETF. Core instrument: VXUS, Vanguard Total International Stock ETF. VXUS holds over 8,000 stocks from developed and emerging markets outside the United States: Toyota, Samsung, Nestle, HSBC, Alibaba, and thousands of others. Each share you own is partially denominated in euros, yen, Swiss francs, Australian dollars, and dozens of other currencies. If the US dollar weakens, which historically it does during periods of high debt and monetary expansion, your VXUS position appreciates in dollar terms. This is automatic passive currency hedging. Expense ratio: 0.07% annually. Complement: VEA, developed markets, plus EEM, emerging markets. For investors who want to separate developed market stability and emerging market growth potential, VEA focuses on Europe, Japan, Australia, and Canada. EEM adds India, Brazil, Taiwan, and South Korea. If you are watching from Canada, the UK, or Australia, the ticker symbols differ in your market, but the logic is identical wherever you invest. Search for a total international index fund in your brokerage. The principle translates directly. Flag 2. The hard asset flag. Gold without counterparty risk. Gold is the only major financial asset that is not simultaneously someone else's liability. A stock is a claim on future earnings that may not materialize. A bond is a loan to an institution that may not repay it. Cash is a liability of a central bank that can print more of it. Gold is simply gold. It carries no counterparty risk. It has outlasted every currency system in 5,000 years of recorded economic history. But here is the critical nuance that most people miss, and it directly relates to the bail-in risk we discussed in Part 1. Buying gold through a standard broker still gives you a paper promise. If the institution holding that ETF were to fail, or if the ETF's custodian bank faced a bail-in, your gold exposure is a claim on a failing institution, not possession of physical metal. In a true systemic crisis, the exact scenario where gold matters most, paper promises are the first things to burn. This is not hypothetical. During the Cyprus bailout in 2013, all financial assets held at Cypriot institutions were affected, regardless of what those assets nominally represented. The structure of how you hold an asset matters as much as which asset you hold. For most investors under 100K, IAU, iShares Gold Trust. IAU is the most cost-efficient, physically backed gold ETF for US investors. Each share represents approximately 1/100th of an ounce of gold. The fund holds actual physical gold bars, audited regularly by an independent auditor. Expense ratio, 0.25%. This is your starting point. It's not perfect. It's still held within the financial system, but it's a major improvement over owning no hard assets. For growing portfolios, 100K to 500K. SGOL, Aberdeen Physical Gold Shares ETF. SGOL stores its gold exclusively in Switzerland, in vaults outside the US banking system. The gold is in a non-bank vault, fully allocated to the fund, and the individual bar list is publicly available on the fund's website. Expense ratio, 0.17%. The Swiss jurisdictional location is the key distinction. It places the physical metal outside the reach of US regulatory action in a crisis scenario. For serious wealth protection, 500K plus. Allocated physical gold in Singapore. For investors with significant assets, the optimal structure is allocated physical gold stored in a private non-bank vault in Singapore. Companies including Malka Amit, Silver Bullion, and the Safe House operate Singapore vaults that can be opened remotely with appropriate identification. Your gold is registered in your name, segregated from other clients, and held outside the Western banking system entirely, beyond the reach of US or EU bail-in legislation. Storage costs approximately 0.3 to 0.5% annually. This is not tax evasion. It is legal, reportable international asset diversification. I want to be clear. I'm not telling you to abandon US equities. The US capital market remains the most innovative, the most liquid, and the most regulated in the world. US companies have generated extraordinary wealth for investors over generations. None of that changes overnight. What I'm saying is that in the current environment, not all US equities are equal. And owning the full S&P 500 without a quality filter means owning significant exposure to the most speculative and vulnerable parts of the market. Core, VOO or IVV, S&P 500 Index ETF, 0.03% expense ratio. These remain the bedrock of most American portfolios. But in the current environment, the S&P 500's performance is heavily skewed by a small number of AI-driven megacaps. A position in the full index is appropriate, but it should be complemented by a quality filter. Quality overlay. SPHQ, Invesco S&P 500, Quality ETF. SPHQ selects stocks from the S&P 500, specifically based on return on equity, accruals ratio, and financial leverage. Screening for companies with genuine earnings quality, not just market momentum. In every historical downturn, quality stocks have significantly outperformed the broader index on a drawdown basis. This is your resilience filter within the US equity universe. International complement, VXUS, approximately 20% of total equity. The goal is that approximately 20% of your equity exposure lives outside the US dollar system, consistent with Vanguard's guidance, providing a natural hedge against dollar depreciation and US-specific policy risk. Flag 4. The cash flow flag. Liquid REITs. If you own a home, it represents a significant share of your net worth. but it has a problem that most people don't articulate clearly. It is perfectly illiquid. You cannot sell 20% of your house in a crisis. You cannot relocate it to a safer jurisdiction, and it carries ongoing maintenance costs that financial assets do not. Real estate investment trusts solve this problem. They give you an economic exposure to real estate, rental income, property appreciation, inflation protection with the liquidity of a stock. You can buy or sell a REIT in seconds. You can sell your entire real estate allocation in an afternoon if the situation demands it. U.S. Diversified, VNQ, Vanguard Real Estate ETF, roughly 4 to 5% yield. VNQ holds over 160 REITs across residential, commercial, industrial, healthcare, and data center properties. REITs are legally required to distribute 90% of taxable income as dividends, making VNQ a reliable yield generator, even in flat or declining markets. In inflationary environments, real assets with income streams tend to perform well relative to pure bonds. International, VNQI, Vanguard Global ex-US Real Estate ETF. For investors who want real estate exposure outside the United States, Japan, Australia, Singapore, the UK, Hong Kong, VNQI provides liquid access to global property markets. This is particularly relevant as a hedge against a U.S. housing correction. Flag 5. The Digital Sovereignty Flag. Hard assets outside the system. Central bank digital currencies, CBDCs, are being developed or actively piloted by over 130 countries. The United States Federal Reserve has been conducting research into a potentially digital dollar through its Digital Dollar Project, and the Bank for International Settlements, the central bank of central banks, has coordinated multiple CBDC pilot programs globally. A CBDC is not simply a digital version of the dollar. It is a programmable dollar, one that can be given an expiry date, restricted to certain purchase categories, or frozen without a court order. This is not science fiction. The technical architecture already exists and is being tested in China's digital yuan and in the Bahamas sand dollar, among others. Whatever your political views, the question of who ultimately controls the money in your account is worth taking seriously. The counterposition to programmable government-controlled money is a small allocation in mathematically scarce digital assets held in self-custody, meaning you, not a bank or exchange, control the private keys. The core property these assets offer is that their supply is governed by protocol, not by political decision. No central bank can print more. No institution can freeze a wallet whose keys only you hold. Whether this category of asset ultimately proves its worth as a store of value remains genuinely uncertain. The volatility is real, and recent market history has been humbling for the sector. What is not certain is the underlying principle. A position that exists outside the conventional financial system provides a type of insurance that no ETF, no REIT, and no bank account can replicate. I want to be precise about the sizing and the framing. This is not an investment recommendation, it is an emergency exit. A 1 to 3% allocation in self-custody digital assets is the ceiling, not the target. The volatility of this asset class in early 2026 alone, with major assets losing 40 to 50% from their peaks, is a clear reminder that this flag is the most speculative and the most optional of the 5. If you are not prepared to study the technology seriously before allocating, understanding private keys, seed phase storage, and hardware wallet security, then skip this flag entirely. The first 4 walls of the Wealth Fortress will protect you. The 5th flag is for those who have already built the others and want one additional layer that is genuinely outside the reach of any institution. Consult a financial advisor before acting on any of this. Your Wealth Fortress in action. We've spent 4 parts building the case: the history, the risks, the psychology, the framework. Now comes the part that actually matters. What do you do Monday morning? I want to be honest with you about something before we go further. There is no single portfolio that works for everyone. A 25-year-old with $50,000 saved has different priorities than a 50-year-old with $500,000. The risks are different. The time horizon is different. The capacity for volatility is different. So instead of giving you one answer, I'm going to give you a tiered framework. 3 levels. Each one builds on the last. And wherever you are today, whatever your number is, there is a starting point here for you. Think of it this way. The Wealth Fortress has 4 walls. What we're about to do is decide, together, how many bricks you can afford to lay right now, and in what order. Tier 1. The starting architect. $25,000 to $100,000. Let's start here. You have somewhere between $25,000 and $100,000 in investable assets. Maybe it's in a savings account. Maybe it's spread across a 401k and a checking account you keep meaning to do something with. You're not rich, but you're not starting from zero either. And this tier, this first tier, is where most Americans actually live. The goal here is simple, and I want you to remember it. Break the home bias. That's it. Right now, the odds are that everything you own, your job, your home, your savings, your investments, is sitting inside one country, one economy, one currency. That is not a portfolio. That is a single bet. And the first thing we do is change that. The allocation I'm about to show you on screen is built from 4 pieces. 60% stays in America, in the 500 largest US companies. 20% moves into the rest of the world. 15% goes into gold, real gold, not a paper promise of gold. And 5% goes into real estate you can sell in 5 minutes, if you need to. A word on these numbers before you see them, because I want you to understand where they come from. Vanguard officially recommends that American investors hold approximately 40% of their equity allocation outside the United States, meaning 60% domestic and 40% international. Our Tier 1 table places 20% in international equity, deliberately at the conservative end of that range, appropriate for a first-tier investor who is building international exposure for the first time. As your portfolio grows through Tier 2 and Tier 3, that international allocation can be increased toward Vanguard's full recommended range. Ray Dalio's all-weather portfolio, designed to perform across every economic environment, allocates roughly 7 to 12% to gold as a structural hedge against currency debasement and systemic stress. Our 15% gold allocation sits above that range, reflecting the heightened geopolitical environment we have been describing. It is a deliberate choice, not an arbitrary number. Research Affiliates, one of the most respected quantitative investment firms in the world, has argued for several years that international equities are significantly undervalued relative to US markets on a cyclically adjusted basis, which reinforces the case for meaningful international exposure even at the entry level. These figures are a starting framework, not a prescription. Your personal situation, time horizon, and risk tolerance may call for different weightings, which is exactly why a conversation with a qualified financial advisor matters before you act. Now, I know what you're looking at, and I know it might feel like a lot of moving parts. So let me make it as simple as I possibly can. If you do nothing else from this entire video, nothing, do 2 things. Open a brokerage account at Fidelity or Schwab Both are free, both are insured. And buy two things. One called VOO and one called VXUS. That's it. Two ticker symbols. One keeps you in America, one puts you in the world. That single move, that one afternoon of action, already puts you ahead of the vast majority of American investors. If you have a tax-advantaged retirement account, a 401k or IRA in the US, an RRSP in Canada, an ISA in the UK, a superannuation fund in Australia, look at your investment options this week. Not next month, this week. Most plans have an international fund somewhere in the menu. Put at least 20% of your contributions there. You don't need to move everything. Just tilt the ship a few degrees. Over time, that tilt makes an enormous difference. And one more thing. Before you invest a single dollar in the market, make sure you have 6 months of living expenses sitting in a high-yield savings account. Not a regular savings account that pays you almost nothing. A high-yield account. Right now, institutions like Ally or Marcus are paying 4 to 5% annually. That emergency fund is not an investment. It is the foundation of everything else. Without it, the first unexpected bill will force you to sell something at exactly the wrong time. The starting architect doesn't need to be perfect. They need to start. Every week you wait is a week your wealth sits entirely inside one country's fate. Tier 2. The developing architect. $100,000 to $500,000. Something shifts when you cross the $100,000 threshold. Not just in numbers, in mindset. At this level, the question changes. It's no longer just, how do I start? It becomes, how do I make sure that what I've built can survive something I haven't anticipated? The foundation from Tier 1 stays. You keep your US equities. You keep your international exposure. But now we refine. We upgrade. And we add 2 new dimensions that weren't accessible to you before. Not because of some exclusive club, but simply because of scale. The first upgrade is your gold. In Tier 1, you held gold through a US-listed fund. It was a start, but technically, that gold still lives inside the American financial system. At this level, you move to a fund that stores its physical gold in Switzerland, in a vault. Not a bank, a vault. In a country that has stayed neutral through every conflict of the past 200 years. That distinction matters more than it sounds. The second upgrade is your equity. Because not all American companies are equally resilient, the broad market gives you everything, including the most speculative, the most indebted, the most fragile. At this tier, we add a quality filter. Companies with real earnings, real cash flows, real pricing power. The kind of businesses that don't just survive a downturn, they come out the other side, stronger. And we add one new element. Very small, very optional. A position in assets that live entirely outside the conventional financial system. Not as a speculation, as an emergency exit. Think of it like a fire door in a building. You hope you never need it, but you want to know it's there. You will notice the international allocation stays at 20%, consistent with the conservative end of Vanguard's recommended range, while the gold position holds at 15%, in line with what managers like Ray Dalio have described as appropriate insurance in a currency-stressed environment. The Treasury Bill Fund provides a layer of bail-in protected liquidity, same principle of keeping reserves outside commercial bank risk, with none of the volatility of more speculative alternatives. Tier 3. The full architect. $500,000 and above. At this level, I'm not going to show you a table, because what we're talking about here is no longer just allocation. It's architecture, It's the difference between a portfolio and a structure, between diversification and sovereignty. The Tier 2 framework still applies. Every flag from every previous tier remains in place. But now we move beyond financial instruments entirely. We start talking about geography, about legal systems, about physical presence in the world. The first edition is physical gold, not a fund, not a certificate, but actual bars stored in a private vault in Singapore. Not a bank, a vault. Companies that specialize in exactly this allow you to open an account remotely, register the gold in your own name, and hold it entirely outside the reach of Western financial regulation. It costs less than 0.5% per year to store, and it's the purest expression of the hardest asset principle we've been building toward this entire video. The second edition is a Swiss bank account. And I want to be very clear about what this is and what it isn't. It is not a secret. It is not a tax shelter. American citizens are legally required to report foreign accounts above $10,000, and this is done simply through a standard annual filing. What it is, genuinely, is an account denominated in Swiss francs, governed by Swiss law, in the jurisdiction with arguably the strongest banking protections in the world. If the United States ever implements capital controls, restrictions on moving money out of the country, your Swiss account is already on the other side of that wall. The full architect has not abandoned America. They have simply ensured that America is one of several places where their wealth exists, not the only one. In a world that is fragmenting, that distinction may be worth more than any single investment decision they ever make. As with everything in this video, none of this is personal finance advice. At Tier 3 especially, the complexity is real. Tax implications, legal structures, reporting requirements vary by individual situation and jurisdiction. Before taking any of these steps, consult a qualified international tax attorney and a licensed financial advisor. The framework is a map. The professionals help you navigate it. Exit liquidity. Why prepared investors win crises. Everything we've discussed so far is intellectually accessible. The instruments are available to anyone with a brokerage account. The principles are not complicated. So why don't more people do this? The answer is psychology. When a crisis hits, when headlines scream about war or collapse, the human brain does something predictable. It triggers the flight response. The amygdala, the primitive part of your brain that kept your ancestors alive by running from predators, cannot distinguish between a lion and a market crash. It just says, sell everything, go to cash, hide. And in a financial crisis, this emotional response is exactly what the sophisticated players are counting on. They call it providing exit liquidity. The panicked sellers at the bottom of a crash who hand their assets to patient, prepared buyers at catastrophic discounts. Warren Buffett's most cited rule: be fearful when others are greedy, and greedy when others are fearful. This is not a clever aphorism, it is a description of how wealth transfers during crises, from the unprepared to the prepared. An empirical data point worth internalizing across the major geopolitical crises of the past 80 years: Pearl Harbor, 9/11, the 2003 Iraq invasion. The US stock market recovered to its pre-event level within weeks to a few months in each case. The permanent losers in those events were the people who sold at the bottom, not those who held or bought. The wealth fortress we've been building is designed so that when a crisis hits, you don't need to make decisions under pressure. Your diversification is already in place. Your gold is already working as your insurance. Your international exposure is already hedging your dollar risk. You have a written plan. You have nothing to decide and nothing to fear. This is not a fringe concern or a doomsday scenario. The Wall Street Journal and Deloitte, whose clients are the largest corporations and institutional investors in the world, now treat geopolitical risk as a standard input in portfolio construction, alongside interest rate risk, inflation risk, and currency risk. They publish frameworks for identifying specific rupture variables, sanctions, capital controls, trade barriers, supply chain fragmentation. What was once considered exotic contingency planning is now a baseline expectation for any serious asset manager. The Wealth Fortress is simply that same institutional discipline, translated for the individual investor. The false dawn, the other side of the trap. There is a mirror image of panic that is equally destructive: premature optimism. The false dawn. In every major financial crisis, there are periods where it appears the worst is over. The market rallies 15 or 20%. The Fed issues reassuring statements. A jobs report comes in better than expected, and millions of investors who sold at the bottom rush back in at the top of the recovery rally, only to be crushed when the structural problems, which never went away, reassert themselves. We saw this in 2008, a significant market rally in the summer of 2008, followed by the devastating fall collapse when Lehman failed. We saw it in 2001, a strong bounce after the initial dot-com crash, followed by a further decline of nearly 50%. The debts don't disappear because the market has a good month. Consumer stress doesn't resolve because the Fed sounds confident. The most expensive investment in financial history is not a bad stock. It is a premature recovery thesis, held with conviction. Your fortress strategy should be set based on structural conditions, the debt levels, the consumer stress indicators, the geopolitical trends we've discussed, not on the mood of any given month's market. Once your wealth fortress is built, the only reason to modify it is if those structural conditions materially change. Not because a headline tells you the crisis is over. Not because your neighbor says the market is back. Structural conditions. We've covered a lot of ground. Let me bring it back to the personal with 3 specific questions I want you to answer. Not someday, but this week. Question 1. What percentage of my total net worth is concentrated in the United States? Count your home, your 401k, your brokerage account, your bank deposits. If the answer is above 80%, you have significant concentration risk. Not a crisis, but a vulnerability that a prepared investor would not accept. Question 2. What percentage of my investable assets are genuinely liquid, accessible within 48 hours without penalty? Real estate equity does not count. Your 401k with early withdrawal penalties does not count. Think about what you could access in a genuine emergency. If the answer is below 30 to 40%, you are more fragile than you need to be. Question 3. Do I own any hard assets that are not someone else's liability? If you have no gold, no hard assets, and no foreign currency exposure, your entire financial life consists of promises made by institutions, banks, companies, governments. In normal times, this is fine. In a systemic crisis, promises are precisely what fails first. The world is not ending, but it is changing faster and in more directions at once than most people are prepared for. The investors who look back on this decade with confidence will not be the ones who predicted exactly what happened. They will be the ones who built a structure that could survive whatever happened, and then held it. Now, the best fortress is built before the storm hits. Go ahead and download the guide now in the description, and share this video with someone you want to protect. And if you want to stay ahead of the global shifts we've discussed today, don't forget to subscribe and hit the notification bell so you never miss a signal. Remember, sovereignty isn't something you buy. It's something you build. To see how these global shifts are already playing out in the real world, click on the video displayed right here on the screen. I'll meet you over there.